That restaurant you think fell off didn't fail. It was changed on purpose. You order something you've had dozens of times before, but now it tastes slightly different, just enough to feel off. Not bad enough to complain, but not the same either. And that's usually where the change begins. Most people assume it's random, bad management, higher costs, or inconsistency, but that doesn't explain the pattern, because this happens across different restaurants, different cities, and completely different brands, in almost identical ways. And that's the first clue. Something systematic is happening behind the scenes. That change usually starts with something customers never see: ownership, and who actually controls the business decisions. When a restaurant becomes successful, it doesn't just attract customers. It attracts investors looking for predictable cash flow. And in most cases, the moment it gets bought, it's by private equity. And sometimes, the business takes on debt just for being bought. Private equity doesn't operate like traditional ownership. They don't buy businesses to run them long-term or improve the product. They buy companies to restructure them, increase financial performance quickly, and then sell them for a profit. They're not trying to build the business. They're trying to exit it. Now imagine a restaurant chain gets acquired by one of these firms. At first, nothing dramatic happens. The branding stays the same, the menu looks familiar, and customers keep coming in. But internally, priorities shift almost immediately toward improving financial performance within a limited time frame. The first layer is cost reduction. Ingredients get swapped, suppliers get renegotiated, and portions get adjusted slightly to protect margins over time. The same dish, but with cheaper ingredients, smaller portions, and less time spent preparing it. Each decision feels small on its own, but together they reshape what the customer is actually receiving. A customer comes back a week later and orders the same meal again, expecting the same experience they've had before. This time, the portion is slightly smaller, the texture is different, and something feels off, but it's hard to explain. They don't complain, they just notice it, and that subtle shift is where the system starts becoming visible. A few weeks later, they come back again, and now the service feels slower, and the experience feels inconsistent. Nothing is obviously broken, but the reliability is gone, and that's when people start disengaging without realizing why. The next layer is labor. Staffing gets reduced, shifts are tightened, and experienced workers are replaced with lower-cost alternatives wherever possible. From the outside, everything still functions, but internally, the margin for error becomes much smaller. And that's when small problems start stacking up over time. Orders take longer, mistakes happen more often, and consistency becomes harder to maintain across locations. Nothing breaks all at once. It just slowly becomes less reliable. Pause for a second, because this is where the pattern becomes obvious. And this is where it stops being about the restaurant. Because the biggest shift isn't operational. It's financial. In many cases, the acquisition itself is funded by placing debt directly onto the company that was just purchased. Which means the restaurant now owes money, not because it failed, but because it was bought. Now the business has to generate enough cash to operate, improve margins, and pay off that debt at the same time. So every decision moves further toward efficiency and further away from the customer experience. At a certain point, the system stops making improvements and starts pushing limits instead. Costs can only be reduced so much, so the only way to increase returns is pushing more volume. That means more orders, faster turnaround, and less time spent on each individual customer experience. The business starts operating at maximum efficiency, but with almost no flexibility left in the system. And here's the part most people don't realize. In some cases, the company is forced to take on even more debt, just to pay the investors who bought it. So the business is literally funding its own extraction. At this point, the outcome is already being locked in. The system isn't trying to improve the restaurant anymore. It's trying to maximize how much value can be pulled out of it before the next transition happens. And that creates a very specific pattern. The business looks stronger financially for a period of time, margins improve and costs drop across the board. But underneath that surface, the experience is slowly getting worse. Customers don't leave immediately. They adjust, they come back again, assuming the last visit was just a bad experience. But over time, That pattern becomes consistent enough that the habit eventually breaks. By the time the business is sold again, it often looks stable from the outside. Revenue is consistent, operations are optimized, and the brand is still recognizable to customers. But internally, the system has been stretched to its limits, which means the next owner inherits something that works, but only under constant pressure. And once that pressure changes, the decline accelerates much faster than before. So from the outside, it looks like the restaurant just declined. But what actually happened is much more predictable. Because once ownership changes, incentives change. And once incentives change, the experience follows. And once you see this in restaurants, you start seeing it everywhere. It shows up in healthcare. Hospitals reduce staffing levels to control costs, increasing pressure on workers and reducing quality of care. It shows up in housing. Properties are acquired, rents are optimized, and maintenance is minimized to maximize financial returns. It shows up in retail. Products get redesigned with cheaper materials, supply chains get optimized, and quality declines across entire product lines. Different industries, same pattern. Ownership changes, incentives change, and the experience changes with it. You can even see this happening in real time. A restaurant that once had consistent reviews suddenly starts getting mixed feedback from customers. People mention smaller portions, slower service, or inconsistent quality across multiple visits. If you read enough of those reviews, a clear pattern starts forming. Not a single bad experience, but a gradual shift across everything. There's also something else that happens once this pattern starts. The business becomes harder to fix, even if someone tries to improve it later. Because the systems, suppliers, and staffing decisions are already locked in. Reversing those changes isn't simple, it's expensive, and it cuts directly into margins. So even if a new owner wants to improve the experience, they're working against the system already built. And most of the time, they don't rebuild it. They continue optimizing what's already there, because it's the safer financial decision. If costs get reduced, quality drops. If quality drops, consistency breaks. If consistency breaks, customers disengage. And once customers disengage, the business declines faster than it can recover. So when people say a restaurant fell off, what they're actually seeing is the result of that system playing out. Because once a business gets bought, it stops being about the customer. And at that point, the restaurant isn't the product anymore because you are.